I don't want to be a process junkie, right? I do what I do best, which is raising capital, talking to customers, shaking hands and kissing baby sort of thing. The other stuff, the day-to-day grind, I leave to someone that is going to be managed by a supervisor that is going to give me results at the end of the day, at the end of the week, at the end of the month, and we compare those, gigantic spreadsheet as to what our production goals are for that specific quarter.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Al Curiel is a real estate investor that focuses on performing notes, and he also has a mentorship program that focuses on investing in real estate using the power of meditation. Al, welcome to the show.
Thank you, Sam. Good to be here.
Absolutely, Al. The pleasure is mine. There are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start? Where are you now? And how did you get there?
Started back in 1983 when I was 22 years old. Started with my first building. It was a rental building. And I learned quickly that you need a whole lot more than just money to succeed. And my brother and I started the business. We survived through some of the corrections and eventually became wholesalers, fix and flippers, renters, and all that stuff. And then finally in 2008, as a result of the waterfall from the 2008 debacle of the subprime market, we started focusing on performing and unperforming notes.
Wow. So you've been in real estate, gosh, you're going on 4 decades at this point.
That's exactly right. I hate to admit it, Sam, but that's exactly right.
Hey, lucky you. Some people don't make it that long. So, there is that bright side to it. But you've seen a lot. I mean, you've seen the savings and loan crisis. You've seen the .com bust. You've seen the '08 crisis. And now on the verge of who knows what right now, as we see banks starting to collapse and things like that. So I don't want to dig in too far really into each of those sections. We just don't have time on the podcast. I'd love to hear kind of all the different things that you've done in that. But tell me why you do what you do now. I know we talked about this a little bit off air, and you kind of gave me some insight into the mess versus message, or mess being your message sort of thing. So if you don't mind, give us some insight on that.
Not at all. I'll try to be as brief as I can, given the time constraints that we have, Sam. But basically what happened was being in so many markets and seeing so many adjustments, I couldn't tell. I didn't have a crystal ball to predict the future, but I certainly had a rearview mirror to see where we had been with, as you mentioned, the dark Monday of October 29, 1989, what happened with the Y2K anticipation, with the savings and loans collapsing, and now the 2008, 9 and 10 issues with subprime markets. That made me realize that I was not going to have time to recover from what I had seen in the past. So I decided to research for something else. And that's when I discovered that the passive income that you realize from investing in performing and unperforming notes is where it's at. And that was a result of again, what happened in 2008. So they had the fallout of that mess still happening. Now you have COVID that happened in 2020. So we had a revival of that. You had the waterfall of 2008 that was still not resolved. The world stops, but commerce didn't stop. Commerce continued to work. So you had the supply chain issue. You had the perfect storm of COVID, and then the fallout of 2008. So what was going to happen to all that inventory of properties? And the answer was in the bank's inventory that were not being sold. So we did some research. My brother decided, he's got a family, so he says he couldn't withstand the rigors and the stress of not having inventory to flip. So I did it alone, and I discovered that investing in notes was a lot easier than investing in fix and flipping, because you can make money with a pen instead of swinging a hammer, right? And that's what we've been focusing for the last, now 10 years now.
Wow, that's really, really cool. And are you buying just performing or performing and non-performing notes?
We purchase the performing notes for our portfolio. We purchase those for our retirement through our Roth IRAs. And the non-performing notes we rehab we rehab them. Just like you can rehab a house, you can rehab a loan.
Right.
You have three different ways of rehabbing, quote unquote, a loan, and those we sell to our customers by way of partials. So let's just say, Sam, for instance, you have I buy a 30-year loan from, let's just say, Bank of America. Bank of America wants to send me a loan that is not performing. I buy it at a discount. I fix it a little bit, and then I flip it to Sam. So out of that 30-year loan, I sell Sam 10 years. At the end of the 11th month, the 11th year, the note comes back to me. So why do I do that? Two things. I share the risk with my customer, and the customer gets the truly passive income that he wants for a certain period of time while he tries it out. If he likes it, he'll continue on with it. If he doesn't, we part company friends and everything is cool. So that's our mantra, that's our model. My avatar, our personal avatar is, as I told you before the start of the show, is somebody at or near retirement age that has three concerns: his health, not outliving his income, and establishing a legacy for his ascendants and his descendants. So that was my issue. So I figured that this is something that most people in my age group would probably want to hear about, and that's why we created the mentorship program.
Yeah, I mean, because I can only imagine. I think you shared. I don't know if you said your age here on the show, or you told me that beforehand. But either way, you know who your avatar is, and you know what their concerns are. And I would imagine the note space is something that, like you said, you can make money with a pen, not with a hammer. And the person in your avatar, I'm
62, Sam. Full disclosure, I'm 62. I'm not afraid to say it.
You're not afraid to say it. Great. I didn't want to air your dirty laundry. No, I'm joking. It's not dirty laundry here on the show. But I think that's a really powerful thing, because you've defined who your avatar is and what it is that they need. And I think so many people haven't, especially as we are raising capital, as we are doing deals, don't necessarily know who our investor base is necessarily. They haven't figured out what their areas of concern are, and then they can't appropriately bring a product necessarily to market that particular person may need. Tell me, I guess, from a more just the nuts and bolts of what you do. How do you scale the note investing business?
We have, I realized initially it was just a one-man operation, right, Sam? And then with the advent of my brother, after we decided that to part company because we ran out of inventories and we found ourselves empty-handed after 89, after 2000, he just couldn't stand it. So he says, "We have no inventory. What now, Einstein?" And I said, "I got a family. I got a family." He says, "Okay, God bless you. Go." So I had to be a one-man operation. And as I started investing in it, it was just me. But as I started to get more properties and I started raising more money and I started getting more investors, then I had to seek the services of virtual assistants. So now for that, I have several assistant firms that help me with different tasks. I have an acquisitions manager, I have a sales manager, I have a due diligence manager, and then I have a sales manager. And these are people that are in the Philippines and do some of my calling. I have people in India that do some of my systems and social media management. And then I have people in Jamaica that do the actual negotiations, and the sales manager is there so that I hold everyone accountable. We have meetings every Tuesday afternoon. We find where we were last year, how many leads came in, where we're at right now, how we are in raising money, and where we go next month. So we have to keep everything in a journal. And I write, I don't know if you can see, but I got journals that go back about 35 years of everything that I do every single day of my existence. I journal every day, I meditate every day, and I draft a plan of action for how my day is going to shape out and how it ended up looking at the end of the day. So that keeps me focused and allows me the flexibility and the latitude to pivot if I make changes to my scaling business.
Wow, that's really, really cool. I would the building the system with that many or building your systems around virtual assistants. I think that's one. You hear of VAs handling certain repetitive tasks, data mining, whatever it is, but scaling it the way you have done it, it sounds pretty powerful. I mean, what are some of the tips or maybe challenges that you faced when scaling with VAs, and how did you overcome those? Because I think, go ahead.
It was a trial and error enterprise, Sam, because I initially started with one individual, and I thought this person was going to be the be all end all, and it's trial and error, Sam, because sometimes they don't work out, sometimes they do, and so what I try to do is I try to keep them motivated and have three of everything. If I have a solid, let me just give you, for instance, without getting too deep in the weeds and bore you to death, but basically, let's just say for my due diligence, I have someone that is, I got hired somebody that is really good. And then through this other website that I go for, Upwork or assistant.com or something like that, I get a mediocre one. And then one that is okay, but it's a workhorse, but works when he or she wants, which is not really effective. So I have three of those, so that I'm constantly hiring. So if the bad one falls off, then I have another bank of VAs that I can pick from, so that is going to replace the not so good one with a mediocre one. Well, then if the mediocre one in the middle falls off, then I have the really good one to replace him. And I just I continue to mix and experiment with their motivation, with what their why. You got to find out your why, and then I let them go with what they do. Always keeping them on task and always having meetings to hold them accountable. It was really difficult, but we had the system down really good, so that I know who I can call on what task on any given day. And when you motivate them like that, when you keep them on a I don't want to say short leash, but it is a short leash, then you know what they manage your expectations and you manage theirs.
Right. No, I think that's super powerful, and that's I like the doing things in duplicate or triplicate there, where if something isn't working out, you're not dead in the water because you put all your eggs in one basket, and they move.
It is huge when we realize. I mean, and I'm paying these folks, nominal amounts by U.S. compare standards, but still, nevertheless, I need the activity. I need to continue to be out there. I don't want to be a process junkie, right? I do what I do best, which is raising capital, talking to customers, shaking hands, and kissing babies, sort of thing. The other stuff, the day-to-day grind, I leave to someone that is going to be managed by a supervisor, that is going to give me results at the end of the day, at the end of the week, at the end of the month. And we compare those, gigantic spreadsheet as to what our production goals are for that specific quarter. And we match those. And if we need to tweak it, we tweak it.
That's really, really powerful. I love the thought process behind that, and also just the idea that it's trial and error. I think so oftentimes we get it right the first time, or it's like, okay, we're going to do this, and this is the way we're going to do it. Whereas it's probably more of an iterative process than we want to admit.
Really is.
Let's talk a little bit about deal flow. I mean, how do you, when it comes to the scaling side of things, how do you get meaningful deal flow in the note space? Like, who sells them? Who buys them? How do you get in front of sellers? It seems like an obscure market.
Yeah, it is a rather obscure market. Not many people know about it. It's a specialized niche that, again, was found through trial and error and just investigating. And I'm one stubborn son of a gun. The more you tell me you can't do something, then the more I'm going to try and prove you wrong. So that's part of my stuff. That's my makeup. That's my father's teachings and us and what have you. He was an entrepreneur himself. So I don't give up easily. And so I decided to look into what was the problem getting inventory of houses to rehab in 2008. And through, again, researching, I found out that banks and hedge funds have specific asset managers that are tasked with getting rid of inventory of notes that they don't want, that are not working, that are not performing, or that are performing, and the bank and the hedge fund needs capital to redeploy to be able to lend for cars, personal items, appliances, whatever, what have you. So I decided, let's just say, for instance, one day I decided to call the Bank of America of the world, the asset manager, or the Wells Fargo person of the world, or at Digital Capital hedge fund on any given day, and say, Mr. Asset Manager, this is Curiel from the name of my firm, blah, blah, blah. Do you have any assets that you wish to get rid of this quarter. And initially, Sam, I'm not gonna sugarcoat it. It was a lot of rejection. They didn't know me from Adam, but I stayed consistent. I decided when it was a good time to call. I decided, let's be smart here about this, Curiel. I don't call on Monday. I didn't call on Tuesday. I didn't call on Wednesday. I started to call them when the week was kind of dying down, Thursday and Friday. At 2 o'clock, they're more likely to pick up the phone. So I started establishing more dialogue. So after you establish rapport and more dialogue, then one day, Sam, boom, I got an inventory of 20 non-performing loans. And lucky for me, I had capital that I had raised before that I was able to buy in bulk. So now I have a set of 20, a list, or what they call a tape. I don't know what they call it, a tape. It's a spreadsheet of 20 loans. And they said, all right, pick whatever you want here. And if you want to buy them all, we'll give you a greater discount than buying on a per piece basis. I will sell you the case and you can sell them off by the bottle. I said, okay, so I had enough. I had enough of a discount built into it because we're still talking 2008 when you can get $100,000 loan for $13,000. I was able to do that. I bought all 20 of them. I established a rapport with that company. All I need is 5. All I need is 5 for the number of investors that I have. So I established rapport with another one and another one and another one. And that's how the scaling came about. I'm giving you the Reader's Digest version of it. There's a lot more that goes into it, Sam, but for our purposes, that's basically how it happened.
That's really, really fascinating, because that was going to be one of my questions, was when you're dealing with Wells Fargo, Bank of America, I mean, I can't imagine that they'd want to sell one at a time loans off. That just seems just not the way they're going to do business.
Correct. They don't. And they give you, when those asset managers are people like you and me. They get up in the morning, they have families they have to feed, and they have quotas to get rid of loans that they need to get rid of. And if they don't, there's hell to be paid. Right. So it behooves them to work with as many investors and to show how serious these investors are. So if they offer me a bulk of a lot of 20, 25, whatever, maybe commercial loans, I have to have enough backing, meaning capital, so that I can build my credibility, continue to keep that credibility so that the inventory keeps coming. So that's why you have to anticipate, you have to plan how much money you're going to raise before you approach these people. And I'm just using the example of Bank of America. Regional banks are very good for that. Regional banks sell assets that sweet spot for us is anything between $25,000 and $120,000. Right? That's our sweet spot. And you find those mostly in the Rust Belt states.
Right.
All right. It's hard for investors in New York and in California to get their minds wrapped around the low band assets in those states. And I'm talking about Michigan. I'm talking about Indiana. I'm talking about Ohio, maybe some Georgia, maybe some South Carolina, and definitely some Texas. And so I can get an asset, again, to give an example, to be very simple about it, $100,000 loan that I can pick up for about maybe 40 cents on the dollar.
Wow.
So, when I have these people in San Francisco, the investors in San Francisco, where a mailbox is $150,000, right? I mean, you can see how there's like, oh, okay, well then I don't have to deal with toilets, trash, or non-paying tenants.
Right.
I can be the owner. I can take the place of the bank, be the bank, right? And not worry about servicing anything. And I get the monthly income. All I get is a servicing company that is going to allocate your escrows, your taxes, and your insurance. And then the difference goes in Pocket National Bank every month.
This is really fascinating. And I love personally the non-performing note strategy. I think it's a great one. It's where there's opportunity, I think, still. And I'm invested as a passive investor in some other non-performing note funds, even one I think is based out of your hometown there in Chicago.
Okay.
But how has that pricing changed? I know you mentioned before, you said maybe in 2008, like 10 to 20% maybe was the range that you were buying those on. And now you're saying you can still pick up NPNs in the 40%.
40%, yeah. And the reason for that is because now that the cat's out of the bag, so to speak, it's a sexy thing to invest in. Now, most people are now finding out about non-performing notes.
Right.
As you get more demand, obviously the price goes up. Right. So that's what happened. But with volume, now you continue to have the discount. So I'm beginning to see those. It used to be 65 to 75% for non-performing notes. Now they're coming down to like 55, 45, 40 cents on the dollar. That's how I'm able to get them. But initially in 2008, because they were virtually unknown by anybody.
Right.
The discounts were greater, but now with time and more investors being involved, more mentorship programs out there, more gurus teaching this kind of thing, it's become more of a sexy thing to invest in, and not as readily available as it was. But still, you can make very, very healthy returns. And if I may share with the group with your group what some of those rehabbing strategies are.
Yeah.
One is to modify the loan.
Yep.
If you can modify the loan, and if the person loses his job, the person stops paying his mortgage for a variety of reasons, not the least of which is divorce, loss of a job, some kind of loss of income, right? But they love the house. You see flowers are on the flower bed, and mama don't want to move, right? She just wants to do whatever they need to do to make it. That's number one thing. So you modify the loan, even though they get a job at a lesser paying thing, you can reduce the mortgage, you can reduce the interest rate, you can modify it, period. The other thing is if they modify the loan and they are still not able to pay it, then I like to be really tough on the problem and soft on the people, Sam. So I say, why don't we part friends? We've tried this modification of the loan. You can't pay it. I'll tell you what I'll do. I will not report those 4 or 5 months that you're behind to the credit bureau. I will back up the U-Haul. You put all your stuff in there. You leave the house just as clean as when Bank of America or Wells Fargo sold it to you when you got your loan. And upon inspection, if everything is copacetic, I'll drop you a check for $1,000. You give me the keys. You give me the deed, and we're good, right? That's
they avoid a foreclosure on the record that way.
It's a deed in lieu, exactly, right? Cash for key, deed in lieu. So they avoid foreclosure, and there's no deficiencies that I demand. So we leave in good. He has a chance to start life anew. And the third thing, which is the more drastic measure, is foreclosure. And that is the reason why I do not buy in judicial states. Judicial states like Illinois, I do not buy in my own backyard, because in Illinois, foreclosing on somebody is going to take me about 298 days. I can't afford that because I deal with the velocity of money with my investors. They can't sit there waiting for their money to be returned, right? So I go to non-judicial states like, again, Texas, Michigan, Indiana. Even though it's judicial and non-judicial, there's special ways that you can do to speed up the process. Georgia and one of the Carolinas. That's where we focus our investments in. And so that's how we are able to scale, how you were to rehab the loans. And if somebody's not paying, I'm taking it all the way to foreclosure, I can wait no more than 120 days.
That's fantastic, Al. I got about 25 more questions for you. We're at the end of the show. This has been absolutely fascinating. I love your strategy. I love the way you do it. You've shared with us systems. You've shared with us the value of non-performing notes. You've shared with us the ability and kind of the mindset behind finding who your investor avatar is and how you solve their problems. If our listeners want to get in touch with you or learn more about you, or maybe even the notes that you guys are working on right now, what is the best way to do that?
You can contact our website. You take a look at our website. It's associatesinrealestateholdings.com. I know it's a long one, but it's associatesinrealestateholdings.com. Or you can get on our list. It's info@associatesinrealestateholdings.com. We're going to have our first 3-day event coming up at the end of May. So if anybody wants to get details, they can find them at info.
Fantastic. We'll make sure we include that all there in the show notes. Al, thank you again for coming on the show today. I do appreciate it.
Sam, take care.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much, and hope to catch you on the next episode.